Upstart just dropped its 2025 shareholder letter, and let me tell you, it's signaling a huge shift in how they talk to investors. This isn't just another update, it's a completely new playbook. So for analysts, for investors, digging in and really understanding these changes is going to be absolutely key to modeling this company going forward.
And this quote from CEO Dave Girouard really sets the stage perfectly. You see, it's not just about raw growth, it's about smart, efficient growth. This kind of performance, massive scale combined with profitability, is exactly what gives them the confidence to make the strategic pivot we're about to break down.
All right, before we dive into the weeds, the usual quick but important heads up. This explainer is purely for educational purposes and is definitely not financial advice. All the data, all the numbers we're about to discuss come straight from Upstart's own public filings. So here's our game plan. We're going to start by looking at the incredible 2025 performance that made all this possible. Then, we'll dissect their new disclosure strategy, get to the bottom of the shift to annual guidance, decode their pretty ambitious long-term targets, and then wrap it all up with some actionable takeaways for your models. Okay, first things first. We have to talk about Upstart's landmark year. You know, their confidence to completely overhaul their reporting strategy doesn't come from nowhere. It's built directly on the back of their recent performance, which really lays the groundwork for everything else.
Let's start with the top line, a 64% surge in total revenue. That pushed them right past the $1 billion milestone for the first time. I mean, this isn't just a little bit of growth, it's a powerful demonstration of serious market penetration and scaling ability.
And what's fueling that revenue? A massive increase in the number of loans originated on their platform. We're talking nearly 1.5 million, more than double what they did the previous year. It just shows that the velocity on their platform is accelerating, big time.
But here's the real kicker. This growth is profitable. After a pretty substantial loss in 2024, Upstart came back to post over $53 million in net income. That kind of turnaround is exactly the indicator of financial health that analysts love to see. And when you put the numbers side by side like this, wow, it really tells a story, doesn't it? Revenue and originations have almost doubled, but look at adjusted EBITDA. It has exploded from just over $10 million to $230 million. That's not just incremental growth, that is a fundamental transformation of the company's financial profile. So with that incredible performance as the backdrop, it starts to make sense that they feel now is the time to pivot. And that brings us right to our next section, Upstart's new disclosure playbook. This really does mark a new era in how they're communicating with the street. Okay, so what's actually changing? It boils down to three key things. First, they're killing quarterly guidance. That's a big move. From now on, it's an annual outlook only. But to give us a more timely read, they're introducing something new, monthly origination volumes. This is great because it'll give us a high-frequency pulse check on their core business activity. Now for all you modelers out there, listen up, because this is a critical update. They've tweaked the definition of conversion rate. It's now based on legitimate inquiries. So what does that really mean? It means we should get a much cleaner, more accurate measure of their funnel's efficiency by filtering out all the noise and bots.
And this is absolutely crucial for your models. Upstart has gone back and restated the old figures to align with this new methodology. So, to make sure your year-over-year comparisons are accurate, you have to use the updated historical data. If you don't, your numbers are going to be way off.
So what's the thinking behind all these changes? Well, according to the CEO, it's about giving everyone a courtside seat. By pairing high-frequency monthly data with a long-term outlook, they're trying to give us a clearer view of both their immediate progress and, well, their massive long-term potential. And that brings us to the heart of their strategic shift, the move to annual guidance. This is a very clear signal that Upstart is prioritizing its long-term vision over any short-term market noise. And of course, the obvious question any analyst is asking is, why now? Why walk away from the quarterly guidance that the market has gotten so used to? This slide here really captures the logic perfectly. By moving to an annual cadence, Upstart is actively trying to break free from the short-term pressures of the quarterly cycle. The focus is shifting to aligning investor expectations with the long-term health of the business, instead of just reacting to every little bit of market volatility. It's a real sign of maturity. To go along with taking away the short-term quarterly guidance, Upstart has given us a new long-term anchor to focus on. So, in our next section, let's decode their new 2028 targets.
And here it is. This is the new headline number for your long-term models, a 35% compound annual growth rate for total revenue over the next 3 years. That's a confident, public commitment to staying on a high-growth path.
And this chart really visualizes what that 35% CAGR actually looks like. It projects a path from just over $1 billion in revenue in 2025 to roughly $2.6 billion by 2028. It just clearly illustrates the massive scale of their ambition.
So this slide pulls it all together. We've got the 35% revenue CAGR we just talked about. We also have a long-term goal for a 25% adjusted EBITDA margin, and for the immediate future, they've given a 2026 outlook of about $1.4 billion in revenue and a 21% margin. These are the new cornerstones for your financial models.
Okay, so let's synthesize all this into our final section, analyst takeaways. Now that we have Upstart's new playbook, what are the key things we need to be watching?
I think it boils down to a three-step checklist. First, you have to leverage that new monthly origination data to keep an eye on near-term trends. Second, you have to benchmark their annual performance against that 35% CAGR target. And third, you have to track their margin expansion towards that 25% long-term goal. These three metrics are going to be the real test of whether their strategy is working.
So the key takeaway is really this. Upstart is using its recent success as a springboard to completely reshape its investor narrative. This is a very strategic move away from short-term market pressures, and it's a clear commitment to executing on a long-term vision. And this brings us to a final, really thought-provoking question. In an environment that's so often dominated by short-term thinking, has Upstart just set a new benchmark for how high-growth tech companies should be communicating with the market? You know, their success or failure in this could have a really lasting impact on investor relations for years to come.